Welcome to the ProfitMaxx software tutorials. This tutorial series will help you better understand the setup of your ProfitMaxx software and let your service department realize the benefits of proper technician management much quicker. Let's get started.
Chapter 2. Understanding the Key Performance Indicators. The key performance indicators are going to be the standard by which your technicians are measured. So it's absolutely critical as we go through this chapter that you understand each and every key performance indicator within the ProfitMaxx program. There are 24 key performance indicators within the ProfitMaxx software. These will be used to manage your technicians and therefore the profitability of your service department. What we're going to do is review each and every key performance indicator. Each one is a carefully researched industry average. We've reviewed over 30,000 tickets in order to come up with good, accurate information for these key performance indicators. Each of these, however, can be modified or changed to better fit your company or your situation. Each will be automatically collected, calculated, and accurately reported by ProfitMaxx in a very timely manner. To the left, you'll notice a report entitled Key Performance Indicators. These list all 24 key performance indicators within the ProfitMaxx software. You'll also notice that each one is kind of in a section. The first section we've highlighted here is called Revenue, and this is the revenue for the demand service portion of your service department. I would like to make one comment here because it's critical in terms of your learning to properly use the software. Anytime you have a report, anytime you're looking at data entry, anytime you're setting up your criteria for your company within the ProfitMaxx software, if you have a question about what's on the screen, just press the F1 key. There is a phenomenal help screen process within this whole ProfitMaxx software program. So anytime you're looking at anything on the screen, just hit an F1, boom, you'll have a very, very detailed help screen to help you understand exactly what you're looking at. Key performance indicator number 1. Average revenue per hour. The average revenue per hour is all revenue generated from service work, does not include maintenance, divided by the total overall hours worked. Now remember, earlier in the tutorial, the first one we went through, we said labor cannot exceed 25% of gross sales. So to set our goal here, we're going to take our highest loaded hourly rate and we're going to divide it by 0.25. So in our particular case here, we're going to take our highest loaded hourly rate, which is $19.87, divided by 0.25, and that means our goal, in this case, is $79.48 per hour. That's our average revenue per hour goal that we're shooting for. Our second key performance indicator is called average revenue per billable hour. And this is the average revenue per billable hour is all revenue generated from billable calls, including tune-ups but no maintenance, compared with the amount of time spent on those calls. That is real service dollars divided by real service hours. Now this is a ProfitMaxx generated number based on your setup numbers of your hourly rate, your diagnostic fee, your travel times, repair diagnostic, and any expected parts revenue. So again, this number is not something you're going to input directly. This is a number that will be generated by the ProfitMaxx software based on the information that you put in setup. Our third key performance indicator is what we call the percent of revenue goal from opportunity. The tech's daily revenue goal is adjusted for transfer time, sick and personal time, early off, no work, formal training, and vacation. So it's the actual income from demand service compared to the adjusted goal. Once that adjusted goal is set, our goal here is to hit it 100% of the time. Just to clarify just a little bit, our average revenue per billable hour that we just talked about a moment ago was $130.29. If in fact our technician was right on target, billed exactly the way he should have, they'll hit 100%. But if they exceed their goal, they bring in more income than we expected, their goal may be 100, but it's going to show 110 or 115 on the report. Likewise, if he bills out less than $130 an hour, it's going to show something less than 100% on the screen. The fourth key performance indicator is called Billable Index. Now this is very, very close to what we just covered. One that we just covered was percent of revenue goal from opportunity. When we talk about Billable Index, the fourth key performance indicator, what we're talking about here is the revenue that's generated while the technician is billing on the job, and versus the expected average revenue per billable hour. The fifth key performance indicator is called billing efficiency. Billing efficiency. This is a technician's billing skills compared with your billing format. That is your flat rate or your time and material. This indicator includes only demand service calls. These types of calls have a specific pricing format established by your company. The technician should bill the customer all services performed: trip charge, diagnostic fee, hourly rate, and parts sold. When they do that, they'll hit 100% of the goal. Let's look at an example to help us understand billing efficiency a little bit better. Let's say our billing format looks like this. Our diagnostic fee is $72. Our internal hourly rate is $135. And we figure it takes 20 minutes travel time, 15 minutes diagnostic time, and actually 45 minutes of repair time. And we're going to sell $30 worth of parts. So let's assume, for example's sake, our customer's actual invoice was $165. So let's see what our billing efficiency is. Well, our goal was $72 for the diagnostic, plus 0.75 of our $135, that's 45 minutes doing the work, plus our $30 worth of parts. Well, that totals $203.25. That was my goal. Well, if I take the $165 I actually collected, divided by my goal of $203.25, that means my billing efficiency was 81%. If I'd billed out absolutely properly, I'd have had 100%. In this case, we only hit 81%. That's my billing efficiency on this service call. Key performance indicator number 6, residential C.O.D. Now note this is residential, not commercial. We realize commercial, for the most part, we have to invoice the customer. So we're honing on just residential customers right here. So the definition goes like this. This is the percentage of all calls where money was collected. If the tech went on 100 calls during the month and he collected money on 87 of those calls, the system is going to say, hey, this tech collected 87% of the time. Now the first section we just looked at, which was called revenue, dealt specifically with demand service. The next section, as you see on your screen, the next section of the report is called residential maintenance. And this deals strictly with residential maintenance income. The seventh key performance indicator is called maintenance agreement efficiency. This one's pretty easy to understand. Let's say your billing format for your maintenance agreement was that the technician should be on the job 45 minutes. So the question is, how long did he actually take him? If it actually took him 45 minutes to do the job, then he's going to hit his goal perfectly. He'll be at 100% efficiency. Again, if the goal is 45 minutes and he finishes it in 40 minutes instead, the report's going to show him more efficient, maybe 110 or 115% efficiency. In other words, he finished the job in a little bit less time than we'd estimated in our billing format. The eighth key performance indicator is called maintenance call efficiency. Call efficiency. This looks at the entire call, and it includes the maintenance credit dollars, the extra parts and accessories that are sold on the call, and it includes travel time. This is all compared to the required dollars per hour for a normal service call. The goal is for the total maintenance call income per hour to equal or exceed the required service call's hourly rate. When the maintenance call dollars per hour equals service call dollars per hour, your efficiency is going to be 100%. The ninth key performance indicator is called repair revenue per hour. These are the extra dollars generated by your technician when he's out there doing a maintenance call. This could be in the form of additional repairs, or it could be in the form of add-on sales. The goal, as you see from the report over here, is to bring in an extra $40 per hour when he's out there doing maintenance. So we're going to add up all the income he has over and above the maintenance agreement, and we're going to compare that to the $40 per hour. This is a very easy number to hit. if the technician is spending time going through the process looking for extra repairs. We're now moving into the third section of the Key Performance Indicator report. Again, the first section was on revenue, and that dealt with only demand service revenue. The second section dealt with residential maintenance, only the items having to do with our residential maintenance agreements. This third section we're looking at is entitled Profitability, and this combines the service and the maintenance revenue for the company. The 10th Key Performance Indicator is called Average Contribution Per Hour. By definition, this is all revenue generated from demand service and maintenance, that is escrow dollars and add-on sales, compared with the total overall hours worked. Now you notice again our goal was $79.48 per hour. If you look all the way to the top of your report, you notice our average revenue per hour was $79.48 as well. So again, we could be perhaps low in our demand service dollars and high in maintenance, or we could be high in maintenance and low in demand service. What we're looking at here is a combination of all the work that we do. As long as we're hitting our goal here, everything else should be in really good shape. The 11th Key Performance Indicator is called Percentage of Revenue Goal from Opportunity Blended. And again, this is going back to how much of that $79.48 did we actually hit. The technician's daily revenue goal, remember, is adjusted for travel time. It's called TO1. Sick and personal time, it's called AO7. Early off work, AO4. No work, AO8. And formal training, AO3. And vacation, AO5. The actual income from demand service and maintenance is then compared to the adjusted goal. Once the daily goal is adjusted, the objective is to hit 100% of the goal. Our 12th Key Performance Indicator is called Performance Indicator Overall Hours Demand Service. In order to have a gross profit of 50%, this goes back to setting our hourly rate like we talked to in the first tutorial, in order to have a gross profit of 50% from the service department, you cannot have more than 50% cost of goods sold. The greatest cost of service is labor, which cannot be more than 25% of your cost. In summary, it's the total cost of your fully loaded labor divided by the total service revenue collected, not including maintenance monies. To be profitable, a tech's overall labor cost cannot exceed 25 or 25 cents of dollars received. Key Performance Indicator number 13. Performance Indicator Billed Hours, that is while billing demand service. By definition, it's calculated by taking your individual technician's fully loaded wage and dividing it by the actual revenue generated per billed hour for the tech while doing demand service work. The goal is 20 or 20 cents on the dollar. If your billable percentage of labor to sales is consistently over 20, then your hourly rate is set incorrectly and must be adjusted, or your technicians are not billing out completely and accurately. Key Performance Indicator 14. Performance Indicator Overall Blended Hours. And again, here we're combining the income from the maintenance portion of your business as well as demand service. When we take all of the labor cost and divide it by the total demand service and maintenance credit per hour, again, labor cannot exceed 25%. To be profitable in the service department, total cost of labor cannot exceed 25% of gross sales and labor credits. Now let's look at our Key Performance Indicator report again. We've been through the top section, which was revenue, which dealt specifically with demand service. We've been through the residential maintenance section, which again dealt strictly with our maintenance agreements. We've been through overall profitability, where we blended the two areas together. And now we're moving into what we call Profit Smart Performance. What we're talking about here is additional sales leads and maintenance agreements that are sold and renewed by the technician. Key Performance Indicator number 15, Sales Leads Overall. Of all the calls that a technician goes on during the month, 12% of those should be turned into what we call a qualified sales lead. Now, we need to define a little bit what a qualified sales lead is. Qualified sales lead is when a technician is in the home, he sees that the equipment needs to be perhaps replaced, or at least the customer needs to be thinking about upgrading their system for whatever reason. So the technician talks to the customer, explains the situation, and simply asks, hey, would you like someone from our company to come out and talk about the possibility of replacing this piece of equipment? If the customer says yes, then the technician gets the customer on the phone with the home office, and between the two of them, they set a specific time for the salesperson to come out. That's what we call a qualified sales lead. Key performance indicator number 16, sales leads old equipment. Now again, a moment ago we talked about the fact that of all the calls a tech goes on, 12% should be turned into a qualified sales lead. Now we're honing it down a little bit more. Now we're talking about old pieces of equipment. And again, when you go through setup, which you haven't reached yet, but when you get through the setup portion of ProfitMaxx, you'll define what's new, medium, and old equipment, both by the type and by the number of years. But when we talk about old equipment, whatever you define that to be, when the technician's out there looking at an old piece of equipment, of all the old pieces of equipment they looked at during the period of time, 33% of those, not 12, 33% of those should be turned into a quality sales lead. Key performance indicator number 17 is maintenance agreements sold overall. Now, if you've been in the industry very long, you've heard a number floating around the industry that says, hey, of all the calls a tech goes on, 25% of those should be turned into a maintenance agreement. Well, that's not really fair when you think about it, because if a technician goes out and he has 5 calls today and every one of those customers already has a maintenance agreement, how's he going to hit that number? So again, to be fair to the technician, the ProfitMaxx software will screen out all the customers who already have a maintenance agreement. So our goal here is 42%. What that means is of all the calls that the technician went on, of the customers who did not already have a maintenance agreement, 42% of those should be turned into a maintenance agreement customer. Key performance indicator number 18, maintenance agreements sold old equipment. Now remember, a moment ago we wanted all of our customers, we wanted 42% of them to become a maintenance customer. However, when it comes to old pieces of equipment, we want a maximum of 12% of those customers to become a maintenance agreement customer. Now the obvious question is, why do you want the lower number? Well, because those old pieces of equipment should be turned into quality sales leads. We don't want to be selling a bunch of maintenance agreements on equipment that's getting ready to wear out. Those things should be turned into a qualified sales lead. The next section of our key performance indicator report deals with what we call labor leverage. This is when we're determining whether we have the right number of technicians on the job and their billable ratio versus the unbillable time, callbacks, and things like that. Those are things that we group together and we call labor leverage. Key performance indicator number 19, manpower. Manpower is the amount of time a technician is utilized in a productive activity based on the number of service or maintenance calls per day. In essence, do we have the right number of techs? You'll notice that the report on the left, it says 4 is how many technicians we actually have, but what it's telling us is we only really had enough work that month for 3.3 technicians. Now, obviously, we don't want to make some quick assumptions here and get rid of a half of a tech, which we couldn't do anyway. But we do want to watch this number over 3 months, 6 months, a year, and we begin to consistently see that we've got one more tech than we really need. That's when we need to start thinking about cutting back a little bit. Because there's this law of nature, and the law of nature says all of nature abhors a vacuum. If you send 4 guys out today, guess what? They're going to be busy all day long. So by looking at the numbers within ProfitMaxx, we're going to find out how many techs we really need to have on the job, and that again will help you increase your productivity and your profitability. Key performance indicator number 20, billable labor hours. Now, we got to think about this one a little bit in the sense that our vacations, our holidays, things like that are already filtered out. What we're talking about here is the amount of time we're actually on the job. So this is the ratio of time spent on billable service calls to all non-productive time. And non-productive time is defined as manager's applied time, AO1, unapplied time, which is basically time that is not accounted for anywhere on the timesheet, and wait time due to customer no-shows. When we go through that process and we filter those out, that means for every 10 hours we bill out, we're allowed to have 1 hour that we were not able to bill out. So again, our goal here is 10 billable hours to 1 non-billable hour. Now I need to make one clarification here, because some of the people who have purchased ProfitMaxx and are working with it right now have been through Grandy & Associates 3-day basic business boot camp. And you remember, those of you who went through that, we talked about non-billable time being roughly 50% for your service tech. Well, the difference is when we talk about non-billable time in the boot camp scenario, we were talking about any time that we pay the technician for that we can't charge a customer. So that included not only our shop time and travel time, but also included vacations, holidays, sick time, warranty, company meetings, basically every moment that we paid them for we couldn't charge the customer. We're calling non-billable time. From the ProfitMaxx perspective, ProfitMaxx counts travel time and diagnostic time as billable, but vacations, holidays, and sick are not part of the equation. Therefore, when we're looking at ProfitMaxx, we want 10 hours of billable time to 1 hour non-billable time. If you're looking for the overall time that's paid, when we looked through the boot camp scenario, we were looking at roughly 50% non-billable time. So we need to just clarify that a little bit, just in case you've been through the boot camp and you're a little bit confused at this point. Now in this particular situation, we're going to combine 2 key performance indicators, number 21 and number 22. And that's percentage of service calls versus percentage of travel time. Our objective is for those 2 numbers to be equal. That is, if one tech does 28% of the calls, he should have 28% of the travel time. If that's the situation, everything's just exactly the way it needs to be. Be aware that poor travel habits aren't necessarily the technician themselves. It could be a dispatching problem. You could have a dispatcher who pays more attention to one, likes one tech better than the other, and what happens then? Well, that dispatcher sends one guy to this end of town, then the next one, guess what? It's all the way across the other end of town. But one of the beauties of ProfitMaxx is there's a report within ProfitMaxx called the Dispatch Order Report. So if you suspect you've got a problem with your dispatcher, simply pull that report out and see how they were dispatched. Were they sent all over town, or were they sent around the proper way? If they were sent around properly, guess what? It's not a dispatcher problem, it's a technician problem. Now again, our goal here for travel performance is this. The goal is for each technician's percentage of total calls to equal their total percentage of total travel hours. If a technician takes a greater percentage of service calls and uses a lower percentage of travel hours, then they're traveling well and they're traveling profitably. Let's look at an example here. We have Technician A and we have Technician B. In terms of our percentage of service calls, Technician A took 27% of the calls and only 25% of the travel hours. That means he's doing really, really well. Now, on the other hand, Technician B had 25% of the total service calls and he had 27% of the total travel hours. That means Technician A is traveling better than Technician B and performing more service calls. This 2% difference will show up as only 3 to 5 minutes per day longer average travel time. Now that may not sound like a lot, but it is. Let's look at an example. One technician's average travel time is perhaps 30 minutes, while another one is 26 minutes. That's only 4 minutes difference. That doesn't seem big. But this seemingly insignificant difference is equal to losing 8 to 10 service calls per month, or 100 to 120 calls per year. If your average invoice is $200, then a technician can easily lose your company $20,000 to $24,000 per year in calls not taken due to unmanaged travel efficiency. That is significant. Key performance indicator number 23, first time completion percentage. If you thought travel habits were causing you money, wait till you see how this one can affect your bottom line profitability. This is the percentage of time a technician completes a call on the first visit. When a technician cannot complete a call on the first visit, this constitutes one fewer service call that they could have run. Our goal here is to complete the call 95% of the time on the first call. Now when you begin to review the timesheet, you'll notice that last thing on there says, did you complete the call? And if not, they have to say why. Now that may be lack of parts, that may be lack of technical expertise, but they have to explain why they didn't complete the call. Now again, failure to hit that 95% mark can be very, very expensive for your company. Let's look at an example. A company with flat rate pricing based at $135 an hour and a $72 diagnostic fee has an average demand service invoice of $204. Now let's assume your company only does 3 calls a day. Most of the time it's more than that. But let's assume it's only 3 calls a day. That's 756 calls per year. If the technician's first-time completion ratio is 80% instead of 95%, that's 151 calls that they couldn't go on. Well, 151 calls times an average of $204 per call in lost opportunity, that's over $30,000 a year. By managing your completion ratio to 95%, you could increase your billing by $23,093 per tech. That's huge. Key performance indicator number 24, callback percentage. Historically, we know that all manufactured parts typically fail 2% of the time. So what we're going to do in our key performance indicator here is say, okay, we'll give the tech a little bit of slack. Rather than 2%, we're going to give him 2.75%. So what we're saying is any time they have callback percentage higher than 2.75%, guess what? That's not a part failure. That's an improper installation. And our tech's going to need some training. So our key performance indicator is 2.75% in terms of our callback percentage. Hopefully this tutorial has given you a better understanding of the 24 key performance indicators within the ProfitMaxx software. Keep in mind that you can replay this tutorial anytime you wish. You can stop it, go backwards, come forward, or just come in another day and review all the information once again. Also remember that you can press the F1 key anytime you're viewing any screen within the ProfitMaxx software to receive a detailed explanation of what you're viewing. This is the end of this tutorial. Select the next tutorial you wish to view.